Today, we will talk about the gross income multiplier, GIM, which is a rough measure of the value of an investment property. A gross income multiplier is a rough measure of the value of an investment property. It is calculated by dividing the property's sale price by its gross annual rental income. Investors can use the GIM, along with other methods like the capitalization rate, cap rate, and discounted cash flow method, to value commercial real estate properties like shopping centers and apartment complexes. Valuing an investment property is important for any investor before signing the real estate contract. But unlike other investments, like stocks, there's no easy way to do it. Multiplying the GIM by the property's gross annual income yields the property's value or the price for which it should be sold. A low gross income multiplier means that a property may be a more attractive investment because the gross income it generates is much higher than its market value. A gross income multiplier is a good general real estate metric. But there are limitations because it doesn't take various factors into account, including a property's operating costs, including utilities, taxes, maintenance, and vacancies. For the same reason, investors shouldn't use the GIM as a way to compare a potential investment property to another, similar one. Instead, they should use the net income multiplier, which factors in both the income and the operating expenses of each property. The GIM is a great starting point for investors to value prospective real estate investments, but it does offer several key drawbacks to consider when using this figure as a way to value investment properties. Because it's a rather crude valuation technique, it doesn't explicitly consider changes in interest rates, sources, revenue, and expenses. For example, a property under review has an effective gross income of $50,000. A comparable sale is available with an effective income of $56,000 and a selling value of $392,000. Our GIM would be $392,000 divided by $56,000 equals 7. Using this multiplier, we see this property has a capital value of $350,000. Here are 3 key takeaways. 1. A gross income multiplier is a rough measure of the value of an investment property. 2. GIM is calculated by dividing the property's sale price by its gross annual rental income. 3. Investors shouldn't use the GIM as the sole valuation metric because it doesn't take an income property's operating costs into account. Hope this would help. Thanks for watching.